Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episode as soon as they're available. Last full week of August. I'm very excited because I hope that you're all going to tell me that next week is going to be more exciting. But we do have one exciting thing at the end of this week, which is Jackson Hole. So I'm going to go straight over to you, Jan, because it feels like that's really all that markets are waiting for this week. I should say that we're recording this on Wednesday and it's probably likely to be published on Friday. So if you're an early listener, you might well be listening to it before Powell. But if you've saved it for over the weekend, then well, perhaps you can just skip over Jan's comments or you can listen to them to see how right he was. But over to you then, Jan. What are we expecting from Friday?
Yeah, sorry. Well, yeah, certainly it could be kind of like a last minute prep for a lot of people going into Jackson Hole, but unfortunately, without making these great forecasts as we're as depending on the release time of this, but I think it's fairly clear now. Markets expect, and so do we, that we're probably going to get a little bit more on the tapering points that were touched upon in the minutes, kind of in the July FOMC minutes that we got. Although we don't necessarily see Powell offering a lot more insight than that. We could hear a little bit more, and we sure hope so, to hear a little bit more on factors such as what they mean about substantial progress and things along those lines. You know, like have we made any more about that progress? Is there going to be any more commentary on the jobs report that came out since the July meeting? But there isn't nothing all too much to expect given what we heard so far. We can see that the committee is not in a place for Chairman Powell to go out there and categorically say this is a decision or this is what we're leaning, and kind of override several what we call, but it could be half of the committee thinking that it should be more dovish or hawkish. So he's just not in a spot now to go out there and push that either side of the narrative. But as a reminder to our listeners, of course, our expectation is for them to announce tapering in November to start in December.
Okay, so all eyes on the September meeting then, I guess, after Jackson Hole. Okay, so switching it over, I guess, from kind of monetary policy more to the fiscal side then, because I guess that's the other kind of story of the week this week is about the fiscal package in the US. Where are we at the moment on that, and what's your outlook for how these kind of discussions progress?
It is, and the fiscal packages in the US are always kind of like a very I don't want to call it arcane, but like a tough issue to navigate. There's so many details behind the scenes. But at the time of recording this, the House had just passed sort of like this step to avoid that basically avoids the filibuster that was last night. There's still a decent amount of arguments between the more kind of progressive and moderate end of the House. So that's not really great news. But now they will start working on a bipartisan bill, which could be up to $3.5 trillion. But we do expect it to come in some form of a watered down, a much smaller package, but eventually pass in a smaller version. As a reminder, the Senate is in recess until September 10th, so anything that needs to go back and forth will have to wait. But we expect any developments on the fiscal package, in generally on budget side, to happen more so in September. Well, I mean, we're already in last week of August, so I'm talking about like late September probably. Which of course brings into the topic of the debt ceiling here, because now we're officially in the debt ceiling period where the government has these constraints, and we're getting more and more questions about, okay, well, when is the drop dead date, which is the date when the Treasury would run out of cash and would have to technically default on its obligations. Our base case for that, just let me jump into that before we kind of go back and forth with questions, but our base case for that is for beginning first week of November now. Previously we had late October, so mid to late October. And that is because it seems like the Treasury's cash position in general is a little bit better than we expected. And by cash position, I mean revenues and outlays have been more positive than what we had penciled in. And that is despite despite the us bringing our extraordinary measure forecast a little bit lower, given Treasury's discussion of what they think they have available. And as a side note, I'll just quickly talk to our listeners about what, give a reminder about extraordinary measures. Basically, these are these kind of accounting methods that the Treasury can employ to temporarily open up some space under the debt ceiling. For example, there are these intergovernmental special issue treasuries which count against the debt ceiling, but they mature daily and are used sort of for like the retirement plans of within the government. What the Treasury can do is they can suspend the issuance of these, and since they mature daily, they'll immediately open up space under the debt ceiling and wait until the Treasury the government resolves the debt ceiling issue. And as soon as there's unlimited or like a much larger space under the debt limit, they'll just reissue those and make the government retirement plans hold immediately. So just going forward, we do expect to see that the bulk of supply reductions are done by the Treasury. We do not, of course, expect a technical default. We do think the late September resolutions will also end up in either increasing or suspending the debt ceiling.
Basically answered all my questions without me having to ask any. The perfect podcast guest. Okay, thanks, Jan. I guess with that, then let's move over to the euro area, Giles, because well, I've got some supply related questions for you as well. I think that's really the theme perhaps of this week, given that we're looking forward to September, I suppose. But before I get to those, I just wanted to talk to you about, market dynamics, really, I suppose. That's what we talk about on this podcast. But we've been bearish pretty much all of the year, I guess, with sort of varying conviction levels as we've gone through the year. But we still have that bearish view. And we're obviously getting closer now to the end of the year where we still have a positive bond yield target. And that's been a hard view to defend, I would say, maybe over the summer when rates, it feels like, have just rallied relentlessly. So do you think now is the right time for investors to turn bearish again, or are you thinking that there's a couple more weeks of kind of more of the rally, or should they have turned bearish last week, do you think?
Yeah, very good question. Listen, I think that, it's very often about timing, isn't it? And I think that my answer is, as the boy who cried wolf on The View, certainly over the summer. So I know that listeners will take it with a pinch of salt. I do think that now is, in a certain sense, in many ways, a sort of local peak in uncertainty. There's a whole load of things that I think will be resolving over the coming weeks. And I also think we're coming off a particularly unusual period over the summer where we've had this big position squeeze that we've discussed on the podcast before. That was somewhat fueled by concerns about COVID, which haven't resolved, but I think not as bad necessarily as people perhaps had in mind at the worst point, perhaps earlier this month. Supply versus the ECB's, the Eurosystems purchases. I mean, that the mismatch was really, really stark over the summer, and I think that should improve a little bit from here as well. So I think those elements are all more or less in place. Then, I guess you're just down to behaviorally. How willing will people be to express this view, which I think is quite consensus, to be honest with you. I mean, we've had lots of discussions, Imogen, because you've been part of them. We've had lots of discussions recently with investors, and most people, I feel, do tend to agree that yield levels are probably too low. Particularly if you're more optimistic on the economy as we are. But there's a big difference between views and positions, and I don't really feel like most people have it on. In fact, I think most people are sort of more focused on the risk thinking about last year, the risk that we are just stuck in a very low volatility sort of rut for the coming months. And actually, again, there are certain things that have to sort of go our way, but I think that they can over the, I think they will over the next few weeks. And if that's right, then I think that people might actually be caught trying to actually express the view that they sort of felt like they had all along.
Let's hope so. You mentioned just then about this kind of, I guess, supply or flows mismatch between ECB buying and the supply that we were getting, and you thought that might shift. I guess, could you just give us a bit more detail on what you're thinking around that? When do you think that might shift? When is supply going to start coming back to the market, and how much are we really expecting supply to pick up in September versus what we've had over the past few weeks?
Well, I mean, there's a whole accounting that needs to be done to just double check all these numbers, and but basically, the answer is from next week the market reopens. There's a big uptick in government supply. There should be a similar uptick from non-government supply. We have EU that still has 35 billion or something to do this year. So I guess you'd expect a slug of that. You've got Germany that has a 30-year to launch via syndication. That could be the first, and I think it's probably either the first or the third week in September, but it's not far off. A couple of other ones as well. Green bond from Spain, for example. I mean, it's going to start adding up, and I do think that it's likely to feel a little bit less tight.
But still tight, or?
Well, okay. I mean, yes, but no. I mean, given where we are in market levels, not so tight that there won't be enough people willing to sell to bridge the gap. Let's put it that way. And that was really the problem over the last couple of months.
That makes sense. I like that. All right, higher yields from here then. I'm holding you to it. All right then, Theo, over to the UK, because the theme of supply continues. There's a couple of things I think interesting in the UK at the moment. But first of all, how about you can tell us a bit about the minutes from the DMO meeting with investors about kind of supply over the next few months?
Sure. So this week we had the meeting between the GEMS and investors. And this is particularly important because it's an opportunity for the DMO to test specific views and to assess to what extent there is demand and what this demand is. So we talk about issuance during the October to December period. Now, what stands out is that there was a discussion on a potential extension of the linked curve, which is a theme that we believe is very, very important for the market. The opinions were mixed, both from GEMS and investors. That does not necessarily mean that the extension is not going to happen right now. And we will get on Tuesday, so the 31st of August, we'll have the precise calendar, so we will know a bit more. Precise calendar does not necessarily mean that we will know whether we do have for sure a curve extension or not, but we will know a lot more. And if the language is encouraging that, yes, a very long dated bond may be issued, then, well, the chances are high, versus, for example, a 30-year linker will be reopened, which definitely pours cold water over the idea of, a link extension. So this is something which is important. The other point that has been discussed quite a lot is green gilts. And this is a topic that we're particularly passionate about. So green gilts, we talk about a 10-year bond coming in September and a 20-year bond coming in October. So again, this is subject to market conditions and everything, as always. So we talk about a new 2033 line coming in September. It needs to be confirmed, but the signs are supportive towards that. In October, will it be a 20? Will it be a 30-year bond? We don't know. But the important part is that the UK DMO is dedicated to construct a green curve. And a green curve needs more than one bond. So it's more likely that none of them will get these two lines in the next month. So this is definitely one important topic, and I think that next week this will be the main driver of volatility, specifically on Tuesday morning when we will get the numbers, where we will get patients cut, and everybody will be looking at net DV1. Story is that there are expectations of that higher net DV1 to come in the next quarter.
Just quickly on the green bonds then, if you're expecting a 10-year first and then a longer dated bond perhaps in October, the DMO have committed to 15 billion in green gilts in this fiscal year, is that right? So how are you expecting, what are you expecting for the size of those two green bonds this year?
Yeah, so as you've said, the DMO, they basically promised that it will be at least 15 billion of green issuance. So we can envision a deal that is close to 10 billion for the first bond, and then depends whether it's a 20 or a 30-year bond. We talk about 5 to 7 billion. The longer the bond, obviously from a DV1 point of view, the smaller the size has to be. But we do expect the first deal to be particularly strong, particularly, you want to create liquidity, you want it to be a success, you just don't want to go small. You want to go with a significant issuance size, and then you want to show that this deal is trading well. So also to me, this at least is probably, a target that the DMO feels that they can easily achieve. Otherwise, you don't set two targets that are too ambitious and then disappoint, right? At least, when I set targets, I set them on a reasonable level so that they can be reasonably achieved and have the pleasure to say that target achieved. So this is what we do expect in terms of sizes. And I think also the point of the curve, so issuing a little bit longer than sharp the 10-year point may be very, very attractive, simply because the curve is particularly steep between the 10 and the 15-year point. So you issue a little bit longer, you get that nice roll down, and a lot of investors will be appreciative of that.
All right, that makes sense. So thinking ahead to the next few weeks, there is a coupon event on the 7th of September. Is this going to be an important driver of markets over the next couple of weeks? And if so, which part of the curve are you expecting this to matter most for?
Yeah, index extensions and coupon money are actually important drivers. The reason why they are important drivers is because even though they are so predictable and known, many investors don't take them into consideration until the last minute. So what you tend to see is really some support for gilts as we head to the ex-div date. So we do expect the last couple of days to see, so the ex-div date is later this week, is on the 26th. So we do expect that support to come at the 5-year sector. So this is the only coupon cycle in the year that is so front-end focused. Usually when coupon money comes in, it is a bit of a mixed bag or back-end focus, for example, the Jan to July cycle. But this one is very much a front-end focused cycle, so the March to September. This means, well, we think that 5-year gilts should be well supported. We think that also 10-year gilts will not be supported in September, especially if you think that we'll have, well, other than the Green Deal, we'll have a lot of other issuance in the sector. So we think that there is, an opportunity when we look at sectors where some parts will benefit more than others from that coupon event. We talk about a significant number, 2.1 billion, but as we say, it is from short-dated gilts. So, and this is what matters. The duration really, really matters, because ultimately we deal with a DV1 impact, and this is what drives the market.
I guess along the same lines, then, is there anything important or what happens to index extensions next month? Is there anything that we need to kind of be aware of on the UK side?
Yeah, I guess on the, well, and here comes the interesting part. Indices that do include green gilts, and this is also a topic that not everybody is in full agreement. Some investors think that their indices will include green bonds, others are not so sure. So those indices that will include green bonds will likely have to contract, because if we talk about a bond with a 10-year or 11-year duration, those indices have got aggregate duration, which is around 12 to 16 years, then that issuance pretty much leads to contraction. And overall, there will be the event of the 7th of September is an extension. It is an extension for the 1 year plus, because there is one year bond which falls out of those indices, and we have also redemption. So if we talk about the event on the 7th of September, this is going to be a curve extension across 1 year plus or anything, all gilts stock indices. This is fairly clear. If we talk about what happens over the month, it is less clear, because also issuance is not so much backdated. So we've published a piece, and the piece really digs into those details, so the interested reader can really go and look at the table and look at the specific scenarios and what happens. In some cases we do get an extension, in other cases we do get a contraction. But overall, I wanted to flag at this point on green gilts and indices that will include them, which is important. And the other point is that, the 7th of September, yes, it will be an index extension event. So for all indices.
Great. Well, yeah, that is super interesting on the green gilts front, and a nice little plug for your piece there. So for any of our listeners that do have access to Agile Markets, please do check that piece out if you're interested. All right, guys, I think that's pretty much all we've got time for today, but we'll catch up next week and we'll at least know what Powell said at Jackson Hole. So I'm sure we can digest that ahead of NFPs next week. Thank you all for joining me. And just a reminder to our listeners that if you like today's episode, please hit the like button to show your appreciation, and don't forget to hit subscribe so you can listen to our latest episodes as soon as they're available. Thanks.